Hello, my name is Jim Penna. I'm the Manager of Retirement Services, and I'm very happy to be hosting this week's special presentation called How to Leverage Your Money Using Options. My goal is to illustrate the following. I want to show you how to filter out the noise and know the important terms of option trading. I'm going to show you the 4 building blocks of all option trades and the difference between buying a stock and buying an option. So why is tonight's presentation so important? Well, if there's one thing I want to convey here, it is that until you know how to use options correctly, your portfolio will never achieve its full potential. And that's why this presentation, I believe, is so important. When you know how to use options the right way, they can help you significantly increase your annual returns. Now, obviously, not everyone is an options expert, and in fact, a lot of people wouldn't even consider themselves an options novice. Now, I've been working with investors and retirees here at VectorVest for a long time, and I know that those with no experience or limited experience often tell me that they just don't know where to start. They feel lost sometimes, which either causes them to drop it altogether or to make mistakes when they do try and get into the options market. They end up confused or intimidated by all of the terms and the horror stories, and they feel boxed in. Now, what they also tell me is that they want to use options because they know it's a great way to leverage their capital. When using options, you're able to get the same or even better returns by using less capital. That's the definition of leverage. So you need to ask yourself just a couple of questions. First, why do you want to learn about options, or why should you learn about options? And second, what's holding you back? So with those questions in mind, again, one of my goals is to show you how to filter out that noise and how to focus on the most important terms and things you need to know. Now, there are terms you'll learn as you gain more experience with options, but let's focus on the main terms first and get right to the useful information. We'll be like a horse with their blinkers on. We'll focus on the most important items first and not get distracted. A lot of people, when they start trying to learn options, get intimidated by all the jargon. I mean, you hear things like delta, theta, straddles, and strangles, and all kinds of terminology. And folks who are new to options start to think that only the experts can do it. Even just going into your brokerage account and looking at an options chain can be intimidating if you're not sure what you're looking for. So what you want to do is simplify it. So let me just show a few things that will hopefully change the way you look at options. Let's start by making it really simple. There's only a couple of things you really need to know to understand options. First, you need to understand that there are only 2 types of options: call options and put options. And once you know what those are, all you have to do is know that there are buyers versus sellers. All that other stuff is made up of these 4 basic foundations. The most complex option trade is built from these 4 pieces of information. To help you out, we've got a little table here and we can draw it out. First, on the left, we have the 2 types of options. Again, we know there are calls and puts. We've also determined that there are buyers and there are sellers. Now, when you're a buyer of an option contract, whether it's a call or a put, you pay money. It costs you to buy that option, and what you get for that option are rights. As the seller, you get paid, and for that payment, you now take on obligations conveyed by that option contract. So what do we mean? Well, if you're the buyer of a call option, that contract conveys to you the right to buy units of 100 shares of a stock at a certain price by a certain date. Conversely, if you're the seller of an option contract, you are then obligated to sell units of 100 shares of a stock at a certain price by a certain date. So you take on obligations for getting paid. Now on the put side, if you are the buyer of a put, again, you have rights. And in this case, you have the right to sell units of 100 shares of a stock at a certain price by a certain date. And then finally, the seller of a put option also has obligations, and they are obligated to buy units of 100 shares of a stock at a certain price by a certain date. So buyers and sellers with rights and obligations. The green boxes are green because they're considered bullish trades. Right? You'd be looking to do those in uptrending markets on stocks you believe are going to rise in price, whereby the red boxes here indicate bearish trades. So if I'm the seller of a call and I'm obligated to sell my stock, or if I want to purchase the right to sell my stock, it would make me a bearish trader on those underlying stocks. The buyer of a call or the seller of a put would be considered bullish. So again, once we understand these four basic foundations, there's no option trade we can't understand. Now, one of the great ways to understand options also is by comparing it to something you probably already know, namely buying a stock. Not an option, just the stock itself. So here's an example of buying a stock. Here's a graph of Apple. At this point, Apple was trading at $130 per share for our illustration. Now, how much would it cost you to go out and buy 100 shares of stock? With the stock trading at, we're rounding it to 130, how much would it cost if you were to go out and purchase 100 shares? Well, the answer would be $13,000, right? It would cost you to buy 100 shares of stock at $130 per share. So let's look at a couple of different scenarios here. Let's say we purchase that stock at $130 per share and Apple drops to $125 per share. Well, how much are your 100 shares worth now? Well, we lost $5 on 100 shares. That's $500. So the answer would be that our shares are now worth $12,500. Would I have to sell my shares of stock just because it went down? Well, no, I can continue to hang on to it. It's not a problem. I'm not forced. I have no obligations to sell my shares. Let's say in scenario 2 that Apple rises to $140 per share. Now how much are the shares worth? Well, 140 times 100 shares is going to give me a position worth $14,000. Do I have to sell my shares? Once again, no. I'm under no obligation to sell those shares of stock. So let's take a look on a table here, the examples we just walked through of buying stocks. So on the left here, this is kind of the what if chart. What if Apple were to rise or fall? We're going to fill in our initial cost. Again, we were using $130 per share as our cost basis. That's not going to change. If we buy 100 shares, it's going to cost us $13,000, not including commissions. So let's quickly fill in the other two columns. Well, if I were to sell my 100 shares of Apple right at $130, I would take in my $13,000 and I would have zero profit or loss, right? There would be a flat trade there. Again, not taking into account commissions. Well, again, playing the what if game, what if it went down to 125 and I were to sell my position? Well, I lost $500. And so my value would now be $12,500. If the stock were to fall to 120, my position is now worth $12,000, and if I were to sell it, I'd have a $1,000 loss. If my stock goes up 5 points to 135, my position is now worth $13,500, and if I were to sell it, I'd have a nice profit of $500. And then we'll go to 140. If my stock is to go to 140, I have a $14,000 position, and I have a $1,000 profit if I were to sell it. So I think it's important to start with that as a foundation before we begin to discuss options and compare buying an option versus a stock. So this is something we're all familiar with. Now, our maximum profit for owning the stock, of course, is unlimited. Theoretically, the stock can continue to rise and our profit is unlimited. But what's our maximum risk here? Well, our max risk is $13,000 because that's what we paid for the position. Again, theoretically, Apple could go to zero, not likely, but theoretically our max risk is $13,000. Now let's walk through an example of buying a call option. So once again, we're bullish on Apple. It's trading at $130, but this time we want to buy the right to buy Apple at $130. So we go out and buy one call option, and it gives you the right to buy Apple at $130 per share. Your one call now gives you the right to buy 100 shares of Apple at a certain price. That's $130 per share. That's the strike price. By a certain date. That would be the expiration date. In this example, your call option cost $3.65 per share. That was the premium you had to pay per share, or $365 for one contract. So for $365, we now control 100 shares of Apple. Scenario number 1, what if Apple drops to $125 per share? Would you want to exercise your right to buy Apple at $130 if it were trading out in the marketplace at $125? Well, of course not, right? If I could go out in the open market and buy it for $125, I'm not going to exercise my right and buy it at $130. Conversely, in scenario 2, if Apple were to rise to $140, would I want to exercise my right to buy it at $130? Now, the answer here could be yes, I could exercise it, or I could simply sell my option contract at a profit, because the value of that contract is going to rise as the price of the underlying stock rises. So let's break down buying a call example into our same what-if chart. We determined that we paid $3.65 per share for one contract, not including commissions, is a debit of $365, and that won't change. We'll begin right at $130 if, at expiration of my option contract, Apple is trading at $130, my option contract will have zero value. And so I would have a loss of that initial debit that I paid of $365. What if Apple were to go down to $125 a share? Well, my loss stays at $365, or the debit I paid, regardless of how low Apple would fall. The most I could lose is the premium I paid of $365. Now, let's take a look if Apple were to rise. Well, if Apple were to go from $130 to $135, at expiration of my option contract, the intrinsic value would be $500. Right? I would have the right to buy Apple at $130. It's trading at $135. That would be a value of $500. Now, my profit, if I sold it at that price, would be $135. That's $500 value minus the $365 that we paid to put the option trade on. And then finally, if it were to go to $140, we have a $1,000 value and a profit of $635. Just as if we own the stock, our max profit is unlimited, and our maximum risk, again, is this time only $365. Again, the premium I paid for the option contract. So let's take a minute and compare the stock versus the call option. On February 6th, Apple traded at $129.73 a share. That was the actual price. On March 1st, Apple had risen to $139.79. That's a 7.7% increase in its price. Let's look at the values here and the difference between owning the stock and owning the option. So if you had paid that $129.73, which is where the stock was trading, not including commissions, your cost would have been $12,973. And on March 1st, when the stock rose, the value of that 100 shares would have been $13,979, which gives you a net profit just about 3 weeks into your trade of $1,006. Again, that's a 7.7% return on your investment. Now, had you owned the contract, one contract on Apple, at that $3.65 per share, your initial cost of $365 would have had a value of $1,080. That's a net profit of $715 on your one contract. But when you break it down to the percent gain, that's a 195% gain versus the $365, which was your initial cost. Now that's if you did only one contract. If you had done 3 contracts, for instance, your initial cost would have been $1,095. The value on March 1st would have been $3,240, which left you with a net profit of $2,145. Again, that's a 195% return on your investment. And if we bump it up to 10 contracts, well, you can see the difference as you continue to move up. But that 195% gain after the initial cost or cash outlay, a lot less than if you own the overall stock. Again, the definition of leverage here, using less money to generate higher returns on investment. So the question you'd have to ask yourself once again is, what would be the impact? If I had this working, what would be the impact on my portfolio? We believe that one of the most important shifts that you need to make is to move from just trading stocks, where you mix in some option trading so that you can benefit from the leverage. You'll still do your stock trading. We're not saying move it all over into options, but you should be able to mix in some option trading. Using options, again, will allow your portfolio to reach its full potential. So that strategic shift will be from just using stocks to using leverage as well with options. So you may ask, how do I get started right now so that I can get results quickly? The Options Jumpstarter course, 6 weeks to profitable options trading. It's a complete step-by-step system that shows you how to buy calls and puts to profit in both up and down markets. We will take you by the hand and guide you through the exact step-by-step option profit system you need so that you can leverage your money with options. Now, the outcome of this course is that in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money, again, whether the market's going up or down. Now, if you're new to options or have struggled with them in the past, this is the course for you. We put it together for serious people who want a system to trade options. Remember, the system is the key to your success. So the easiest way to explain it is to map it out for you. And what we've done is set up the 6 modules to build on the previous module. We start with an option foundation builder. We focus on the most important terminology and aspects you need to know. We then have systems for call options and put options so that you can profit in up or down markets. Modules 4, 5, and 6 are key because here's where we actually put it together. Our trade selection module shows us how to find the best stock candidate first, and then go through very specific steps to make sure it's also the best option candidate. Once that trade is placed, the key and the most important module is trade management. Be prepared and know what to do. Set your objectives, your price targets, your exit strategy. So the most important module, I believe, is module number 5. And then finally, module number 6, Ready, Set, Trade. We'll show you in different brokers how to enter trades, how to set up your exit trades, and then we'll provide you with a very specific trading checklist. Not only that, we'll give you 6 live mastery support sessions. So we've got 6 live modules, and in the same week, we'll have another session where we help you implement what you learn, look at what you're doing, and guide you for your specific trades that are in place. And if you can't make it, don't worry. You can submit questions and you can watch the recording. We'll also give you a covered calls for income bonus video as well. Learn how to consistently generate income every week where you can get paid to own your stocks and you can profit even when the market stalls. We have some special pricing on it. It ends Monday, July the 2nd at 5 p.m. for the special pricing, and registration closes July the 3rd at 5 p.m. So we'll start with the Mastery Package for $495. The best value here is you get the full Options Jumpstarter course, 1-year access to the digital course. You'll get the video on how to trade covered calls, and if you're not a subscriber, we'll even give you 60 days of the VectorVest software. Now, what you get with the Mastery Package, again, are all 6 modules taught live with a Q&A session, and then also the live Mastery support sessions. And again, if you can't attend these, they are recorded. That's the Mastery Package registration. We also have a self-study package for $295. You get all of that without the live sessions or the Mastery sessions. This is for the self-study folks who just want to kind of do it on their own at their own pace. Now, if you're an elite member, call 888-658-7638 for your discount, or go to VectorVest.com/jumpstart to sign up for the Options Jumpstarter course. After the course is over, if you show you've done the work, come to the classes, and you're still not satisfied, we'll go ahead and give you a full refund. So the question I like to ask is, how much is it costing you not to do this? Go to VectorVest.com/jumpstart, sign up for these special packages. The special price ends Monday, July 2nd at 5 p.m., and the registration for the course will close Tuesday, July 3rd at 5 p.m. So join us, and we'll show you just how you can use options to leverage your money. And thanks for taking the time.